At what point do you see some sort of pain inflicted on other asset classes then, in relation with our question of the day, other asset classes from the weakness in the oil price? Is this something that will spread?
Well, I think the U.S. high yield market will come under a bit of pressure because it has a large percentage of issuance in the energy space. So weaker oil prices, if they were to be extended, will hurt that market, and that's probably one of the more talked about or vulnerable parts of the fixed income market because it hasn't really sold off with the rise in U.S. Treasury. So I think that's certainly where I would be more concerned with a prolonged fall in the price of oil.
Yeah, Derek, when does this start to spread then, the weakness in oil prices? One of our colleagues on the MLive blog writing that maybe it's only when oil companies start to cut back on capital expenditure that then you start to see this sort of spreading into other assets.
Yeah, well, certainly if you look back to the last price crash, it was the emerging markets and some significant hits in those areas where production is high. So I would expect, it's hard to put a figure on it, but being in bear market, I think will certainly catch the attention of the markets. And certainly if you were to see a further 10% gain from here, I think that would then start to filter through into starting to hit emerging markets and become more of an issue for volatility going forward. I'm
just going to put up a chart that shows the extent of this deep dive that we've seen in oil prices. It's interesting, Christopher, you mentioned US high yield, because others might suggest, OK, so Treasury yields have gone up a bit, but and the Fed has been hiking interest rates, but rates are still, by historical standards, pretty low, and until they get much higher, do we really see any pain in that high yield? So we spoke to a guest earlier on this week who was suggesting that actually US high yield might be somewhere you'd want to go because you get quite a good return if we don't start to see bankruptcies and companies going to the wall, which is of course a big if.
Yeah, well, I think the overall high yield market does provide a buffer from rising Treasury yields, but we're looking as a percentage of an industry that's got a lot of issuance. It's the energy sector that stands out by quite some distance. So it could be the catalyst that actually takes the high yield market over the cliff that people have been talking about.
Yeah, Derek.
Well, I think also you spoke about level of yields, which of course is important. But I think when you look back at cycles historically, it's the rate of change in yields which is important as well. And if you look back at every downturn over the last 4 recessions, I think it is, on average your 10-year yield jumps by around 250 basis points from the previous cyclical low, and that in a sense has brought about the next recessionary period, and that's been pretty consistent. That's over the last 4 recessions.
Yes.
It's also including 1995 where there wasn't a recession but there was a notable downturn. We're at 200 basis points 10-year this time.
Not far to go then. Christopher, thank you, and Derek, thank you very much.